things are going good for the economy. Fastest growing large economy, India, at 6.5%, and tax collections have been very robust. So I have with me someone who would be able to give us some insight as to whether we can continue with this or whether global red flags like this slowdown can, gradualize our pace in any fashion. I have with me the Chief Economic Advisor, Anantha Nageswaran. Dr. Anand, thank you very much indeed for giving me time. Well, actually, I wanted to start with that because as a data journalist, for me, this tax collection is a big deal. Income tax, April to August, is 37% higher. And as you know, nominal GDP is actually now 8% because of the negative WPI. Do you think we are getting something very right and maybe durable in terms of higher tax buoyancy?
Right. No, I think what we are getting is something durable. I would agree with that. Of course, the pace would naturally slow down over time because the base keeps increasing. One reason could be that we are probably not measuring economic activity well. It could be actually the statistical numbers may be understating the true underlying economic activity. That could be one possibility. We should not rule it out. Okay. The other possibilities are that it's a culmination of efforts of many years, technology, and then being able to plug loopholes and making the tax system simpler and easier. Of course, there is much work to be done, but still we have made a lot of progress. And it is also bringing in more taxpayers into the bracket. So I think it is a combination of economic activity, technology, easier compliance. All these factors are playing a part. I will definitely give a lot of importance to the fact that economic activity is quite robust. And that is the single most important driving factor, if you ask me.
Okay. Okay, I'm coming to the growth question in a minute. But, there is also this gaming revenues which perhaps will come. Are you getting a sense that this year we will end with revenues much better than the budget? The BE is, I think, 10.5% gross tax revenues.
Yeah, but BE assumed a buoyancy of close to 1 against nominal GDP of 10.5%. Yeah. Yeah.
So, do you think we will do much better than that?
I think we have data for about 4 months now. I think it's still we have 8 months to go. We have data for 5 months now.
5 months. April, August.
So 7 months to go. I think it's still early days. But on current trends, yes, I think it is reasonable to expect that we will do better than the projected 10.5%.
Okay, okay. So in that case, why are you worried about the next 7 months? Let me come to the growth question.
Sure. Obviously, the world has been changing quite rapidly and not necessarily in the best of directions. There are uncertainties with respect to what's happening to the crude oil price. We know that a couple of months ago or 3, it was $70. Now it is $90, the Brent crude oil price, which matters to India. And I think the global financial conditions are tightening, and the fact that stock markets around the world don't seem to be getting it is actually a cause for concern. Because then, which means at some point they may get it.
Yes.
And that will have its own knock-on effects on sentiment, capital raising, etc. So, and given the September CPI numbers in the US, and of course, I think a couple of days from now, Mr. Powell is due to give a speech at the Economic Club of New York, and we will get good indications as to how he views the situation. But I think there are many factors, and more importantly, the geopolitical developments can have a wide range of possibilities in terms of how they pan out from here. So that's the reason why I would tend to be, not opening the champagne bottle right now on economic growth or, for that matter, tax revenues, etc. Okay. But we are doing well right now. That's a good point. Yeah.
No, your background is that of a finance expert, right? Given your years in banking, what can be the danger of U.S. yields jumping? After all, the 10-year has jumped from 3.5 to 4.8 at on a certain day. Yeah. Should we expect reverses because of that?
Largely, the answer is no. Look, in the financial markets, one thing I have noticed in my 20 years is that within a particular range, if one variable is moving, other variables do not necessarily react. But once they break out of that range and become somewhat completely unhinged from recent trends, then other variables tend to take notice of them. So, for example, if 10-year is operating in this range of US 10-year Treasury is operating in the range of 4 to 5%, then the impact on Indian Treasury yields is not going to be much. And we have seen that the spreads have compressed. However, due to various domestic factors in the US or other greater supply, because international central banks sell treasuries, whatever happens, whatever be the reason, if treasury yields were to rise well beyond 5 and keep rising, then we will see impacts on broader emerging markets in general. And we may not be exempt, but still we may do comparatively better than others, but we won't be exempt. So it's a question of what is the range which is benign, and beyond that range it turns out to be less benign and so on. But relatively speaking, I think India shouldn't be as concerned about it as it would have been, let's say, 10 years ago.
Okay. Yeah, I would think so too, because at the moment the trade deficit numbers are not showing.
Yeah, external balances are in good shape, yeah. Overall.
My big fear is this last 2 weeks, or in fact 1 week, we've got 3 big IT majors announcing their results. TCS said they have reduced headcount by 6,333, and the current quarter Q3 will show a similar reduction in headcount. Infosys has reduced headcount by 7,250, and HCL Tech by about 2,200. Together it is 17,000. So would you worry now this slowdown is affecting us a little more strongly than you are prepared for?
No, I think it may be true that the slowdown globally is having an impact on the order books of these companies, and therefore they are either not hiring or laying off some people, etc. But we should also put it in the context of the fact that they had a booming hiring year in 21-22. And domestically, for example, if you look at in 22-23, IT majors still hired, but at a slower pace. But much of it was made up for by the BFSI sector. So domestically, there will be compensating factors because you are seeing domestic credit growth. And recently, before the monetary policy meeting, RBI came up with its forward-looking surveys. So both from the supply of labor side, i.e. households, their optimism on employment picked up quite significantly. But it has to be matched by the demand side, which is the enterprises. So if you look at the industrial outlook of the manufacturing firms, it matched. So their willingness to hire, not only in current conditions, but also going forward, I think was quite consistent with what the optimism that households exhibited. So both surveys were internally consistent. So yes, there will be some sectors which will face cyclical impacts of what's going on in the world. But I think at the economy aggregate level, it doesn't look like a serious concern.
Okay. No, I'm only adding to this the fact that FDI also is not what it was in 2021.
That's right.
We have clearly seen it fall.
That's right. But it's a global trend, not an India-specific trend. It's not an India-specific trend.
Absolutely. In fact, I'm pointing to everything as the global ambience. Right. The hiring by a seriously export-oriented sector like IT, plus FDI. Right. Together, can this 6.5% that we are hoping for this year and maybe next, is that under threat? No,
I think at the moment I will not say that 6.5% is under threat at all. Because we knew that net exports will not be a major contributor to growth after the rebound in 21-22. But services sector exports have multiple components now, not just the IT exports. Now you have the global capability centers, etc. So I think we are doing all right. But even if that slows down, I think the slack is being picked up by domestic drivers of growth, like private investments kicking in, the residential real estate cycle picking up quite strongly, etc. So we have compensating factors.
Okay. No, I take your point that residential real estate definitely is a big factor. But are you that confident of private capex? We see excellent government capex numbers. I mean, more than the first April, August has done better than what you would expect in terms of the first 5 months. But private capex, we are not hearing big numbers.
The problem with private capex is we don't get periodic data. So I think people are therefore, in the absence of information, people are unsure as to where it is heading. Again, I mean, we do get twice a year private companies submit cash flow information to the regulators, and which means you will get it for the half year ending September. You will get the data only by December or so. And one of the private sector financial institutions does do a good job of compiling these cash flow based bottom up estimates. They have a consistent sample of about 3,500 companies they look at.
Which is big, yeah.
This is a pretty good universe to look at. And on that basis, in 21-22, private capex grew 22.4% and kept up in 22-23 as well by 18.5%. And the contraction in 2021 was about 6 to 7%. And this is a consistent sample of 3,500 companies, and it is not based on announcements or intentions, it is actual cash flow. So money on the ground is getting invested. And this is as far as the data up to FY23 is concerned. FY24, September just got over, and hopefully by end of November, December, we will get early trends. And I think overall, I'm quite confident that the private sector capital formation is not a futuristic story, but a current story. It is unfolding as we speak. So I am confident, therefore, that these domestic drivers would pick up whatever slack that may arise from the external side.
No, this I think is foolproof. The numbers you are quoting. It's no longer an opinion.
Exactly. It's not anecdotal. It's not opinion based. Yeah.
Okay. What about, since you spoke about residential real estate, again, data collected by think tanks is showing that middle income and premium housing is doing well. Affordable housing is not doing so well. In fact, its share over the last 3 years has fallen from 50% of total housing to something in the 30s, around 35%. You think that requires some support? I mean, we even heard some media reports saying that some subsidies are being planned for low income. Affordable housing.
I'm not particularly aware of any recent developments in this regard, but we know that the budget had made a significant allocation to affordable housing. So, but if there are some execution issues, I'm sure the ministry is concerned would be looking at it actively. Yeah.
But do you think it's called for?
I think so. I mean, because interest costs have risen, and of course, income growth has been good for households, and that is why consumption data has held up very well. So it's not that there is a major distress issue, nor have prices gone up so much that becoming unaffordable. After all, the real estate cycle is still in its nascent stages. But given the fact that India has a relatively low housing stock, taking a look at what is sort of holding back the growth on affordable housing is always a good thing to do.
Okay, it's normal to expect as we move towards a general election that something should be given to the bottom of the pyramid.
But that is not what I am talking about.
No, do you think that the big fear for the economy, for the market, is that capex, which is doing so well, government capex, may take a break, and there will be more revenue expenditure. And in the context of affordable housing not doing so well, entry-level bikes not doing so well, in all these categories, premium doing well, you think that there is a legitimate argument?
No, it is difficult to...
With or without election, is there an argument?
It is difficult to speculate on these matters. First of all, for example, two-wheeler sales has been picking up, but some of these people who used to be buying two-wheelers may actually, because the four-wheelers are doing well, unless we know the breakdown of who's buying the four-wheelers. We may think it's only the... Why should we assume that...
Entry segment is not that good.
Okay.
SUV is better.
Okay. So, I mean, but actually, if you look at the Sea Water survey of consumption, consumer optimism, they do it every quarter for the EACPM. And in August, they came out with their last survey. And they found that rural consumers had actually bought consumer durables more than their urban counterparts. And rural consumers have taken a vacation more than their urban counterparts. Oh, okay. So it is not as if the picture of sort of a bifurcated consumption pattern. It is not that clear-cut as anecdotally we keep saying.
No, I'm therefore not...
But whether it requires an intervention or the natural organic forces of economic growth will take care of this is something that we need to look at carefully.
Okay. You don't think there is a case for populist intervention?
Not at the moment, because I think the economy is displaying organic strength, inherent strength, and it is diffusing. If you look at the EPFO net additions, etc., and for that matter, as I said just a few minutes ago, we spoke about the households' optimism on employment and income growth, matched by the demand side from the industry side, points to the fact that there is a natural spillover or diffusion of economic activity into household wallets and so on. So then that is why we have to wait and see where to concentrate our fiscal resources on is something that we need to deliberate carefully.
On that point, sir, I need to take a commercial break. Just give me 1 minute. We are back with more questions to the Chief Economic Advisor. Welcome back to this very special chat with the Chief Economic Advisor, Dr. Anantha Nageswaran. Dr. Nageswaran, thank you very much for your patience. Now, of course, for the big thing that we've got, getting into the JPM bond index, which, even if there is any problem of US yields impacting our exchange rate, we have this, counter. What's your sense? Is this going to make a big difference to cost of capital for us in FY25?
It's very speculative. You see, one of the things we kind of assume implicitly is that everything else remains constant. Yes, then if that is the case, then this index inclusion alone on balance should be positive for bond prices.
It's like 28-30 billion.
Or yields. But then a lot of things will keep changing. So whether this effect is drowned out by other effects or not will determine the eventual impact on bond yields. So I think, again, at the moment, it is too hypothetical.
As Moody's said, this also means that we will be more under the scrutiny of global funds. You think that is a worry? I mean, our fiscal and monetary policy has to be more...
How much more is a matter of debate, speculation, but the fact is India had already opened its bond market to foreign investors through the fully accessible route, and they were looking at the Indian market. And whether this leads to an incrementally higher level of scrutiny or not, it's a matter of speculation. I think
you don't worry that it could be. If I remember right, somebody from RBI had even once said that we shouldn't go overboard with too many FAR securities.
I think the point is whether, I think these are two separate questions. I think the question was whether there would be a greater scrutiny or not. I think that maybe at the margin, maybe there is, there will be, but I don't think it's an order of magnitude that we should be concerned about. Yeah.
Okay. And finally, this LRS issue. The fact that we now we have toned down the amount of controls on credit card spend, but even then that TCS, tax collection at source, of 20% on foreign trips. What is the signal on that? I mean, we are comfortable in foreign exchange reserves.
No, I think there is no question of discomfort or stress in the foreign exchange situation, but it is a matter whereby I think certain, and we already had this provision with respect to debit cards. So it's a question of treating both of them in the same manner. And so there cannot be a sort of a difference in treatment between debit card spend and credit card spend. And also, I mean, it shouldn't become sort of an illegal conduit for capital outflows.
But the 5% TCS was doing that job.
Right.
Now making it 20%, I only get a salary income. And it's only lately in the evening of my life that I can travel abroad.
I think over time, the technological solutions will come such that the TCS and the TDS will be integrated such that you don't feel that this is something over and above what you would be paying, so that it shouldn't matter to you. I think that will be a matter of time before the technological intervention takes care of that concern.
So the trigger for this was to stop illegal people who are evaders?
The trigger for that was, I think the LRS scheme was probably getting abused. I think, of course, for more authoritative information, you should probably speak to Revenue Secretary about it. Yeah.
Okay. All right. It's just that you wanted to prevent abuse. Okay, and the final question, so I think I've taken more time than you promised. 6.5% is good, but we ourselves in the first decade of the 2000s were at 8%. And countries with the demographic dividend like Russia, like China in the 90s were at double digits growth. Do you think we are getting a little complicit with 6.5%?
Nobody is getting complacent about 6.5%. Nobody is saying that 6.5% is the maximum.
I don't hear a better number.
No. I think that is because it's one has to be realistic. It is better to under-promise or under-expect and over-deliver rather than over-promise and under-deliver, because the global context has changed. I mean, the decade of the 2020s to 2030 isn't the same as 2000 to 2010. When the global economy itself was firing on all cylinders and geopolitical situation was not at all as fractious as it is, and globalization was still in its heydays, and supply chain integration, efficiencies, all those factors. And I think if you remember, in the first decade, export growth was a very big contributor, 1.5% percentage points every year. So I think 6.5% is not a sign of complacency, it's a sign of realism under the circumstances. And we have also said, even in the economic survey, that if we are able to continue with our domestic reform agenda at the state level, at the local level and the union government level, then I think when global conditions turn propitious, this 6.5 can go to 7 or 7.5%. But right now, I think to be able to consistently deliver 6.5% real and between 11 and 12 nominal would be a very good achievement under the context in which the world is operating today.
Okay, just a word for the debt markets. Reserve Bank has said that they will do open market sales. Clearly, they want to keep liquidity tight. Do you hope at least, can you reassure them that fiscal deficit will not go over, the government will not borrow more than promised?
From all the indications that I have, I think our fiscal deficit is on target.
Yeah, at the moment, yes. Yeah, but will it remain that way?
Yeah, that's what I said. It looks like, I think, the fiscal deficit trend for the rest of the year appears to be on target to meet our budgeted number of 5.9%.
You're okay with the RBI tightening liquidity?
I have no comments on RBI, yeah.
Thank you very much for spending time with CNBC TV18 and the reassurance that tax buoyancy is good and economic growth should keep to the 6.5% mark. Thank you very much for joining us.